again to the Anteater Wellness Wednesday. This is a program that is presented by the chapters of the Alumni Association. We now have over 36 chapters worldwide. Our presenter today is from the Vietnamese American Alumni Chapter, so we hope you consider investigating or joining this chapter, and if not this chapter, one of the others. You'll learn more a little about this chapter. It's a phenomenal chapter. I am also the chapter liaison for this chapter. I am with the Alumni Association. My name is Elsa Bagrini-Yaka. Thank you so much for joining us tonight. So at this point, let me introduce you to our very generous and wonderful speaker, Jenny Tran. She is going to present on our legal business health. Jenny.
Great. Thank you so much, Elsa. I'm going to start our screen share so that the slideshow would begin and everybody can start kind of sitting back and relaxing and enjoying the content. Welcome to Anteater Wellness Wednesday. Today's topic is going to be on business legal health, before and after during COVID-19. I'm going to be focusing on the choice of entity, and that's the topic of my discussion. This event is hosted by UC Irvine, the Alumni Association, more specifically the UC Irvine Vietnamese American Alumni Chapter. I encourage you to check us out and join our Facebook group. You can go to groups/UCI Viet Am alumni, and there's also a way for you to sign up so you could subscribe to our mailing list. Like Elsa mentioned, there's going to be a way that you can get a thank you email, at which time the resources will be sent over to you so you can really join and collaborate along with us. The UC Irvine Vietnamese Alumni American Chapter is focused on outreach and fostering community and help, especially for the Vietnamese American alumni community. And it really serves to our entrepreneurial spirit to talk about business health. My name is Jenny Tran. I'm a senior business and tax planning attorney at Brown & Strezza. I graduated UC Irvine in class of 05, go UCI, at Loyola Law School in 2010 and Chapman in 2013. My practice area is really advising business owners on mergers and acquisitions, entity formation, such as LLCs, S Corps, C Corps, and LP. And my goal during this presentation is to help you understand what that means. I also practice business succession planning, tax planning, and also corporate governance. So what are we going to discuss today in business legal health? We're going to talk about how to help you design a healthy company from the beginning and inception. Really, what does an entrepreneur need for their business or to take over the world? We have big goals. And if you want to scale back, at least an anthill. And we're going to talk about the variety of different entities: a sole proprietorship, a general partnership, a limited partnership, a C corporation, S corporation, and limited liability company. And when we discuss these different entities, we're really going to go back and forth and talk about the advantages and disadvantages of both, because there's no really one-size-fits-all answer to what the correct legal entity is for you. So I want to give you resources to kind of think through what your goals are in the context of a business life cycle. To share a story about my heritage, my parents immigrated from Vietnam, and when they came to the States, they didn't speak a word of English. So my mom was a seamstress, and my dad was a day laborer. He literally stood on the street with a sign asking for work. And they were fortunate enough where he found work doing hard labor at a warehouse, and they saved up money and bought product from my dad's employer, and then opened up a swap meet over time, and they sold. And during their initial business enterprise, they operated as a sole proprietorship. Well, really more like a general partnership, because the business comprised of my mom and my dad, but my mom will tell you really it was a sole proprietorship because she did all the work. The advantage of having a sole proprietorship is that it's really easy and convenient. The moment you decide that I want to run a business, you are actually already a sole proprietorship. It's really easy to maintain, and the governance structure is simple, and everything really flows directly to the sole proprietor. But there are disadvantages as well. And the major disadvantage is that there's unlimited personal liability exposure for all of the debts and liabilities of the business. And in addition to that, really for every asset that the entrepreneur owns, all of that is actually subject to all of the business risk. From a tax perspective, you can't recharacterize the income. And as we progress, I'll layer on what that really means from a tax perspective. And everything that a sole proprietor earns, it's actually subject to a self-employment tax. And I'll try to highlight what that means as well. A sole proprietorship isn't really that different from a general partnership, except that there are more players within a group. But it's one where it has all of the advantages and similar disadvantages because everyone is jointly and severally liable for the decisions of others. So in the situation where I was explaining about my mom and dad, both of them are really responsible jointly and severally for all of the actions of the business. So there is a slightly different entity, and that's called a limited partnership. And unlike a sole proprietorship or a general partnership, there's someone who actually calls all of the decisions and makes the shots. That person is called the general partner. He's my little brown pawn here that really tells a limited partner how the business is going to be run. The main disadvantage here is that that general partner ends up being liable for all of the risk of the business. And so there's that liability issue there. That's not to say a limited partnership isn't a good entity. There are benefits like pass-through taxation. It's very flexible in terms of how profit and loss gets allocated. And even though there's liability for the general partner, the limited partners, who are just merely passive investors, actually don't have any liability because they have liability protection. And one great thing about a limited partnership is they're not subject to gross receipts tax. And another benefit to the limited partners is that they get the benefit of charging order protection. I'm going to focus on that for a moment and explain what charging order protection means. So if one of the owners of a limited partnership gets into a lawsuit and a judgment is actually filed against them, that particular creditor can't actually go and take their assets. What they can at most do is take the underlying ownership that the limited partner has and sit on it. And if the limited partnership never actually makes distributions or move assets out, then that creditor doesn't really get the benefit of it. So that's why it's called a charging order protection. And as we move along to the next entity in creating more liability protection, I'd like to talk next about the C Corporation. And the C Corporation is a fantastic vehicle. The major disadvantage of it, though, is that it is a separate taxpayer in that it pays tax both on the entity level and the individual level. I will really illustrate what that means on certain critical events, but I really want us to kind of focus on the advantages and disadvantages of basics. The advantage of having a C Corporation as your business entity is that you get liability protection for all parties involved, including officers, directors, and owners. And because of the Tax Cuts and Jobs Act, the corporate level tax is only 21%. And there are certain advanced planning techniques that a business owner can use, such as running fringe benefits through their corporation. And if a business owner plans their fiscal year well, they'll get to sort of plan when they're going to recognize income. So in one sense, one of the benefits of having a C Corporation is if someone's plan is to form a business and really reinvest and have the company grow, then by not taking distributions, that second layer of tax never actually happens, and they're able to only recognize one level of tax at the 21% level. So even though there's a major disadvantage of double taxation, C corporation isn't necessarily a poor choice if your goal is to help the company grow and reinvest in the company. But the most popular form of entity, actually, and if you take a look at the Internal Revenue Sources website, they'll tell you that actually a large majority of businesses that file returns are S corporations. And the major reason why is that there's actually just one level of tax. So it's a lot more simple from a tax perspective. All of the owners continue to get liability protection, and an S corporation allows the business owner to recharacterize income. So earlier when I talked about the sole proprietorship, I talked about how all of the income that a business owner earns is actually subject to employment tax. So for an S corporation owner, what you can do is you can pay yourself a reasonable salary and then take the remainder as distribution income. And that remainder would not be subject to FICA tax. So let me give you an example. So let's just say a corporation brings in a revenue of $500,000. And the business owner says, hey, instead of paying that additional 13.3% FICA tax on the entire $500,000, I'm going to take a reasonable salary of $100,000, and that entire amount is subject to employment tax because it's wages. Then the entire $400,000 remainder would not be subject to employment tax because we deem that as a distribution of profits instead of wages. So that's an example of how an S corporation allows a business owner to recharacterize income where the prior entities don't have that ability. That's a really popular and powerful feature of why S corporations are really the preferred operating entity going forward. There are disadvantages as well. For an S corporation, because of how simple it's supposed to be, it really reflects how small business are able to operate. There's actually a limitation on who can own an S corporation and what type of investors can actually invest in a corporation. There's a limitation that there can only be 100 owners, and not only that, but each owner has to be a qualified type of shareholder. So in other words, it cannot be owned by an LLC or a limited partnership. And that's why when you read the news about large publicly traded companies, they're always a C corporation. So an S corporation really works well for those who are operating on Main Street, but not so much for Wall Street. But let's say you want everything that is the benefit of a limited partnership in terms of flexibility, and you also want to be able to operate a small enterprise. That's where the limited liability company form steps in. So for a limited liability company, the owners are shielded from individual liability. There's also a lot of flexibility on allocating profit and losses. There's a lot of creativity on underlying ownership structure. And I like to highlight this in that if you have a business owner that you want to collaborate with and you want to treat them fairly but not equally, a limited liability company might be a good option for you because you can create creative classes on how profits and losses and income are shared between the two of you. It can be owned by a combination of individuals or businesses. There's no restriction. There's also no self-employment tax for owning and renting real property. And the sale or disposition of real property is only subject to one level of tax. Earlier, when I was talking about the limited partnership form, I talked about how there's charging order protection. Limited liability company owner also gets the same benefits. With all of these great advantages, there are also disadvantages as well. So unlike the S corporation, there's employment tax that gets pegged on to the owners for every amount of money that they get distributed to them. And there are accounting challenges as well if there are 2 or more owners. Really, the biggest disadvantage is something that's known as the gross receipts tax. And before we go into the specifics of what gross receipts tax look like, I want you to think about how gross receipts tax is a tax that attaches to every dollar that one is earned. And so you kind of see the picture on my left of the bundle of oranges in the orange grove. But when you look at net income tax, it's really tax on the end profit. And I'm going to next move you to the table to kind of illustrate what that looks like. So for a limited liability company, they get taxed on every dollar that they earn. So hence that's why it's called gross receipts. And if you look at the gross income column on the top chart, you'll see that if an LLC owns or earns more than $250,000 but less than $500,000, then they're subject to $900 gross receipts tax in addition to the annual flat fee tax of $800. And it actually levels off at if a limited liability company earns $5 million or more, then no matter what, they will end up paying $11,790 for their gross receipts tax. So now let's compare and contrast that to the 1.5% California net income tax. And what you'll see is a business owner has to earn up to a net income of $786,000 before they really hit that same target tax paid. And so that's one major disadvantage of a limited liability company, you know, the large amount of gross receipts tax. And so a lot of times it's viewed as a tax that's given for flexibility. So when you're trying to decide now between an enterprise, between the S corporation or a limited liability company, you have to think, what is your long-term plan? And a lot of folks will actually decide, you know what, I would rather pay this gross receipts tax and get the flexibility in the long term, and that's sort of their goal. So I'm going to take a moment now for us to kind of decompress because that was a lot of information. So we'll take a deep breath, and I'm just going to get into a moment of positivity for you. I think there's a question in the chat, and then I'll go ahead and answer that when we get a little bit closer towards the end in talking about the question asked. So the moment of positivity that I want to offer you all is that the UC Irvine's mascot won the Tokyo Dachi 2020 mascot champion this year. And what does that mean? Well, it's a really big deal because amongst 256 teams, our Peter, the Anteater, actually won first place. And this year, there were over 1.9 million votes that really kind of cast to give you context on what a big deal it is for us to kind of pass on our pride in being an Anteater. So I want to let you know that you zot this, and together we zot. You know, so far we've really just covered the basics of entities, and as a fellow Anteater alum, I want us to kind of move forward in time, and instead of focusing on the introductory aspects of the entities, I want us to talk about, well, it's great that we kind of set the path for the beginning, but what if in the moment we've gone through the introductory phase, we've gone through the growth phase, and we've reached the age of maturity, and you're now operating a successful business. You know, what do we do next? And this topic, part of the conversation, is also geared towards my mom as well, and me trying to advise her, well, now that you do have a successful business, here's some tax implications for you to consider in her business enterprise. We're going to go back in the business life cycle towards the end if we have more time about growth and operational aspects. But I want us to consider now, what if you were selling assets in your business? And I want to distinguish this from selling the underlying equity of each entity. And I want to focus on that because when a business owner sells their business, a large majority of the time, it's really the assets that get sold. So, you know, when my mom started her enterprise, she was sole proprietorship. And believe it or not, she ended up inadvertently becoming a C corporation because she forgot to file something called an S election. So I'm trying to help her fix that. And part of this is to illustrate to her why. So let's say that there are about $6 million of assets at the fair market value. But that doesn't mean that tax is going to be on the entire $6 million, because there is probably some amount of money that was paid to create basis. And as a result of the basis that's already in the $6 million, really the tax that's actually going to get computed is on that $4 million of gain, right? Tax is only computed on the gain aspect of a recognizable event. So go ahead and just focus first on the left side, which is the tax impact of an asset sale, and that's for a long-term capital asset on the C corporation level. So earlier, when I was talking you through the introductory aspects of a C corp, now I was telling you that there are two levels of tax, and especially that at the corporate level. And there's federal tax that attaches and also state level tax that attaches. That's where there's $840,000 of $10,000 of tax, $336,000. And then after that, there could be also shareholder distribution tax and also shareholder income tax, because how are you going to get the actual profits out from the corporation over to the shareholder? And so a total amount of tax that's actually paid on that $4 million is about 2.6. And so the business owner at the end of the day only nets about 1.3. But if you compare and contrast it over to the right side of the S corporation, you'll notice that there's no federal level tax. There is still a state level income tax for S corporations, and that's that net income tax of 1.5% that I talked to you about. And we're going to skip down here to the long-term capital gains tax for S Corp shareholders. So what you'll notice is that the total amount of tax that an S Corp shareholder pays for selling long-term capital asset is significantly less. They only pay $860,000 because of their corporate structure, and they end up netting $3,140,000. So this is a really big difference, and that's why I wanted to move us to the concept of maturity for you, because that will definitely help you highlight, you know, what is it that you want your entity to be, so that you understand how your end game will play out. And so in deciding which entity you want to be, you want to think about the operational aspects, and now you can understand why the tax aspect of how the entity is taxed is so powerful. So the next scenario that I want to talk you folks through is about inheriting assets instead. I really spent a lot of time in this discussion so far with you on how great an S corporation is in its entity structure. But in this scenario, I want you to focus on really the difference between the LLC and the S Corp in the scenario where assets are being inherited. So let's say that my parents decide that instead of selling the company in an asset sale, what they want to do is they want to pass it on to either me and my brother so that we can operate it, for the next generation. And the great thing about an LLC is there's something called basis step up. When my parents pass away, all of the value that they built into the business will not just be that $2 million, that they put in. It'll actually be the entire $6 million fair market value. And that's the benefit of holding assets in a limited liability company, because upon the original owner's death, there's a full basis step up in the assets held. And compared to the S corporation, there's actually no basis step up. And in that regard, there is gain experienced upon inheritance. So you'll notice that the taxable realized gain for an LLC as a result is 0 if my brother and I decide to sell the business afterwards. But for an S corp, it's going to be off of $4 million. So here's the chart to illustrate what that looks like. So it's pretty simple. For a limited liability company, because there's no gain, then as a result, there's no tax paid. And if my brother and I were to sell, we'll actually net the entire fair market value. For an S corporation, there's just long-term capital gains tax paid. Oh, and I think I did some math. I did this backwards. So 2,668 is actually the amount paid, and then the net proceeds is 1.3332 as a result. Make sure we fix this when we send the slides out. So those are just 2 examples of what I wanted to illustrate for a business when they reach maturity, and how it's important for you to decide what your end game plan is with your business if you decide what is it that you want to do at the end of the day to make sure you experience the best decision and plan backwards. So I'm going to take a few moments and just talk about some growth key issues for business owners to also focus on in making sure that they also get from that introductory stage all the way to the level of maturity. So a couple of business growth mistakes that a business owner typically experiences is if there are 2 or more owners, they really should have something called a buy-sell agreement. And the reason why I recommend it if there are 2 or more owners is it really establishes the foundation for how both owners would reconcile their eventual exit from their business. One of the provisions that we recommend in a buy-sell agreement is to establish something called a right of first refusal in the event one of the business owners decide that they want to leave. And the reason why I focus on that right now is that when 2 individuals decide to come forward and form a business, they really don't intend on doing business with their spouse or anyone else in their family. And so in the moment of someone's death or disability, you'll make sure that the one who's continuing to operate the business will continue to maintain control and operate. Oftentimes, insurance also plays a role in this as well. When I advise business owners on buy-sell agreements, I oftentimes add in that certain triggering events includes death. And the reason why is oftentimes a technique to fund the liquidity of a business owner's buyout is really that policy. And what the insurance policy allows the business and the business owner to do is to really help the business owner's family, especially for the one who had passed away, really get the benefit of the proceeds, while the business owner who continues to operate the company will be able to find sources of liquidity and hold the business intact. When you have a buy-sell agreement, it also forces the business owners to come together and agree to a preset value as well. The other growth mistake that business owner oftentimes forget to really focus on is to motivate their employees and to make sure that they remain committed to their business. Oftentimes, we advise our business owners after they've reached a certain level of growth to analyze what are their key assets and resources that are necessary to keep the business growing. And more oftentimes than not, a business owner will always identify their employee. And so what we'll do at Brown & Strezza is we'll formulate certain types of profit sharing plans without creating true equity. And what that does is it helps the employees feel like they're really part of the growth process, because to the extent that they work harder, the company increases value and their profit share also increases value. And finally, the last mistake that a business owner oftentimes fails to focus on is having a succession plan. And that's why I started off with going from the introduction to the age of maturity, so that everybody can figure out what is it that they want to do going backwards. You know, for a lot of folks, they don't intend to work for the rest of their lives, but if that is their plan, then one should plan accordingly and figure out how they're going to be able to continue to do that, either from a legal perspective or from an infrastructure perspective. So I created a summary of charts for all of the information that I discussed earlier with you. And I'm not going to go over all of the information with you, but I'd like you to kind of take the time to digest moving forward, you know, which entity is right for you, in checking off which ones are the most important features and characteristics. There were a couple of questions that were asked during today's discussion. And so there's a question about how, is there a way for a limited partner of a law firm to structure themselves as an LLC to reduce their tax liability on their K-1s? So the answer to that is there may not be the ability for a law partner to be an LLC, because the California Professions Code requires certain professionals, such as doctors and lawyers, to be corporations. And so I believe that for a lawyer, you may actually end up having to be a corporation instead of an LLC. And that's why a lot of lawyers will hold themselves out as professional corporations. Nevertheless, the good thing about being a professional corporation is the ability to recharacterize income, you know, the way I talked about earlier, which was taking a certain reasonable salary and then taking the remainder out as a distribution. So there was an additional question as well about, well, what if a limited liability company is elected to be an S Corp instead? So in one sense, the question is, what are they trying to avoid in having an LLC elected and also being treated as an S Corp? In one sense, the LLC is subject to the gross receipts tax under California, and by electing to be treated as an S corporation or a C corporation, for example, it changes the federal tax nature of the LLC. So if you do that, then as a result, the LLC would still be subject to California gross receipts tax, but all of the revenue that comes in, or gross revenue that comes into the LLC, at least from a federal level, can still be recharacterized as distributions. In that way, the FICA tax won't attach to everything that gets distributed out from the LLC. So hopefully I've answered that question, but you know, that has other implications as well. So what I encourage you to do is to reach out to me and we can discuss that further. I like to close with talking about how society grows great when old men plant trees whose Shade they know they shall never sit in. And it's an anonymous Greek proverb. And this proverb really spoke out to me as of late because of how great UC Irvine has been in really promoting Wellness Wednesdays for UCI and also the community at large. In these times, I hope that you find useful information and that you found this discussion helpful. Over to you, and that I've given you a little bit of shade, especially during the dog days of summer. If you would like a copy of this slide deck or a consultation to any further questions that you have, you're welcome to reach out to me. My email is jenny.tran@brownandstrezza.com, and you're welcome to reach out to me at 949-453-2900. And I like to add that UC Irvine actually created a series of resources to help businesses navigate some of the social distancing aspects of COVID-19. There's a lot of great signages for small businesses as well. Thank you for attending today's discussion. I know that we have a little bit more time, so if you have any questions, now would be a great time to ask. I answered a few more questions. I didn't really see any more in the chat.
No, thank you so much for referring to the resources from UC Irvine for the COVID-19. They are fantastic resources that provide signage so you can use for your small business, as well as insider tips as a business owner. So thank you for pointing that out. And it looks like we do have one other question that came up from Anthony. Would you like to take that? Do you perform business valuations?
Sure.
Good question.
Yeah, no, that is an excellent question. No, Brown and Strezza is a law firm, not a valuation firm, so we do not. However, if you would like a contact to a variety of valuation professionals that are highly reputable, you're welcome to reach out to me, Anthony. I'd like to talk about some of the great usefulness of a business valuation. Oftentimes, the business owner wants to know, what is the value of my business? And really, the first answer is what a willing buyer would pay for your business. But in addition to that, there are a lot of metrics that a valuation can offer to give insight to a business owner. In addition to that, we're on very unique times from a gift and estate planning perspective, where valuations will really help a business owner figure out, is this the right moment for them to really go down the path of utilizing planning techniques for transitioning their business. That's beyond the scope of today's discussion. However, that is also part of my practice. So if you want to discuss what that looks like further, you're welcome to reach out to me.
That was really great. Do we have any other questions? I do see something along the lines of, are you a tax attorney or a corporate attorney?
I'm
very different.
Right. I'm both, and part of it is because a business owner's well-being really is twofold. One from a liability perspective, and so that's where the business law comes in. But really, at its core, it's how much they net in their pocket. So I'm also a tax attorney as well. So I probably went through a little bit too quickly, but I have a master's in taxation from Chapman University School of Law, and that's because UC Irvine didn't exist at that time, by the way. So it is both parts of my practice, both corporate and tax planning.
Wow, we're lucky to have you then. That was fantastic. All right. And let's see. I'm not sure I understand the mental tax discussion.
Sure. So oftentimes, when the California income tax is discussed, it's oftentimes rounded to 13.3%. But if you break down that underlying 13.3%, what does it mean? It actually means that there's a 12.3% income tax, and there's something called a mental tax, and that's 1% across the board. So it's easier when tax professionals talk about it, that there's a quote 13.3 income tax altogether, but if you break it down further, it's actually 12.3 income and 1% mental, and just very specific when I was breaking it down.
Oh, very good to know. Okay. All right, so we have another question here. It says, can you discuss a bit of an LLC being treated as a disregarded entity? Pros, cons, pass-through, etc.
Great. That is an excellent question. So first and foremost, let's talk about what does it mean for a limited liability company to be disregarded, okay? And then we'll talk about the pros and cons as well. So a limited liability company can be, quote, disregarded if there is only one owner, literally owned by one person, owned by one entity, or owned by a married couple who do not file a return separately. And the reason why is deemed a disregarded entity is it's like saying, hey, this particular LLC doesn't need to file a separate tax return if all of the owners in between are the same anyways. And so you can kind of have like a very complex layering of entities that's ultimately pointing up to different types of individuals, even though it's an LLC, if that particular individual is really one and the same. So one of the huge benefits of having an LLC just be treated as a disregarded entity is that they don't have to file a separate tax return. So administratively, it's a lot easier. And oftentimes we'll tell business owners, if they own real property, for example, that they should just own it separately in an LLC for tax purposes, so that they don't create complexity. It could just be a disregarded entity. So for administrative purposes, they don't have to file a separate tax return. And in addition to that, they get something called basis value for the total amount of their loan. So I think maybe what I'll do is I'll put my contact information back up. And so for folks who want to learn a little bit more about what that means for their specific type of activity, you're welcome to contact me and we can talk that a bit further. And so you can kind of figure out, is an LLC as a disregarded entity, the right entity for you? Oftentimes there's real estate involved, and to avoid the complexity of having to file a separate return, that's when it's typically recommended.
Oh, very good. Would having real estate in a trust make a difference?
So owning real estate in a trust does not make a difference from a liability perspective. And let me explain why. When you have assets titled in a trust, you're still alive during the lifetime of your trust, and hence it's revocable. And since you control all of the assets in the trust, it's as if you are a sole proprietor. So having a trust is not a registered legal entity. It really is just changing the title. So my husband's name is Patrick Klinger. So if Jenny Tran and Patrick Klinger form the Klinger Family Trust and we put all of our assets in it, it's just a different way of holding title in name, but because we control it, all of the liability risks that I talked about with sole proprietors and general partners continue to exist. So what a trust allows you to do is avoid probate, and it allows for the orderly administration of the assets for your estate, but it is not a liability protection vehicle. So that's why I put a lot of emphasis earlier on how real estate ownership really is preferred in the limited liability company form. So if we were to layer this, in that question, then what happens is your real property is owned by that disregarded entity, that's a limited liability company, and then the trust owns the title to the underlying equity. So the good thing about a disregarded entity is also its simpler tax form. Earlier I mentioned one of the benefits of having an LLC is that rental income is not subject to employment tax. So you can go back to my slide. I did point that out, but that's why there's a key feature there. You never really want to own real estate in an S corporation. Part of that is earlier when I was talking about selling long-term assets with a basis step up, you end up getting the value trapped, and there's a lot of tax consequences when real property is owned inside an S corporation. Hopefully I answered the question.
Oh, that's great. We have another question here. Are there additional associations, networking organizations that you can recommend anyone with a small business and become involved in them in the future to learn how to cultivate their business and strategic plan? It's a good question.
No, that's an excellent question. If the person who asked the question can tell me a little bit more, and I say that not because the classic answer of an attorney is it depends, but I say that because depending on your enterprise or your passion, that would help you thrive. So I'm going to give a few examples of what allowed me to thrive. Me joining the Vietnamese American Alumni Association really allowed me to thrive. I sat around at the table and listened to everyone share their experiences and their struggles with their unique cultural experiences with immigrating, and that really empowered me to want to speak out. That's not necessarily a professional business organization, but because of them, I'm able to speak before you today, and they gave me a platform. On a professional level, I'm also part of the National Association of Women Business Owners, and I'm a strong believer that if you help a woman, especially a woman business owner, you really help their entire community, and that's a viewpoint that I have. But as an attorney, right, there are resources amongst peers that I need. And so now I have to make a quick shout out to Lynn Tai, who graduated in 2004 from UC Irvine, and she helped me with putting some of these slides together. So as part of UCI, I actually encourage you to find a nook at UCI, because there's someone part of this alumni group that's probably looking to give back to someone like you. So the resources are already there. Hopefully, Elsa, they gave you a little bit more context of their business, and I can make more recommendations.
That is great. And says, I'm a registered sole proprietor established in 2017 consulting business. Well, that sounds good. I am also going to put my contact information in the chat. So if you have any questions about the Alumni Association or about one of the 36 chapters that you may have some interest in, feel free to reach out to me.
Yeah.
But I'm going to share. Is there more that you'd like to add to that if it's a sole proprietor established in 2017 as a consulting business?
Now, you know what I would add is I recently learned from one of my great contacts at NABO is if you have a LinkedIn account, and there's something called Profinder, Profinder. Look that up, because what that allows you to do is to elevate your profile so that if anyone is looking for consulting services, they'll come across your profile because you qualified as a Profinder. My understanding is that it's free because LinkedIn wants to facilitate connections in that way. And the reason why I'm talking about LinkedIn now is because with social distancing, it's definitely hard to go to live in-person meetings. And so how do you effectively connect with a large amount of people without having to physically be present. So I think there's maybe a month ago, UC Irvine hosted a lunch and learn about how to rock your LinkedIn profile. So I encourage you to go back in the history and check that out. I actually attended that myself and I really enjoyed it.
I'm going to add one more thing to our chat. It's antnet.uci.edu. It gives you the ability to network with other Anteaters or be a mentor or a mentee. And there is a group for this particular chapter on AntNet as well if you wanted to connect with other Vietnamese alumni. It's very simple to join. It's free, which is fantastic. It will also migrate your LinkedIn profile right into the AntNet network, which is fantastic. It makes it very easy. And as a mentor, you are able to determine the amount of time that you're interested in spending with the mentee. Is it, well, you know, just a chat over the internet? Is a video conference? You know, along whatever you choose as a mentor, the time that you may have. So I encourage folks to go ahead and take a look at that. Again, it's antnet.uci.edu, and I'll put that in the chat. There you go. All right, so I think we're getting close to time. We may have the opportunity to answer one more question. I think we're good. I think we're clear with that. Is there anything else you'd like to add, Jenny?
No, I want to say thank you for attending. I hope that you got some useful information. And if you want to know more, you're welcome to reach out to Elsa or me. I hope you all have a good day and find some joy during these trying times. Thank you very much.
I also want to let you know that our next Anteater Wellness Wednesday, it's going to be Pro Pilates. So we're going to get a little physical, get some exercise in. That'll be somebody from the campus-wide Honors Collegium chapter. It is the Anteater Wellness Wednesdays are every fourth Wednesday of the month at 7 p.m. Please go ahead and register for that. That'll be fantastic. Along the future, we will also have an Anteater Wellness Wednesday with UCI Mind. You know, that's a growing concern about Alzheimer's, so there'll be some great content there. So keep in touch, keep posted. Thank you very much for all the positive comments here. We're thrilled that you can join us. Let's see, I think your webinar confirmed my family made the right decision to open an S corporation. Oh, that feels great. I love hearing that kind of positive response. We wish you the best on that corporation, the construction company. That's fantastic. Let's see, there we go. Thank you so much.
Okay, thank you all.
Again, we will provide the slides and other resources, such as maybe the Pro Finder that you suggested, and also the link for the COVID-19 support that UCI provides. All right. So Zot. Thanks again, and we hope to see you next month.
Have a good night, everyone. Bye.